Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to keep it short. We're just going to look at the Primary Vision Frac Spread Count, so you don't have to hear me ramble on, as I've already done that enough for this week in the EIA show and the Econ show. So, just before we get into it, please like, share, subscribe. Your support is greatly appreciated. So without further ado, the Primary Vision Frac Spread Count dropped by 3. So last week it was 130. This week it's 127. And as we said last week, we were expecting to see some of these one-offs come off. We had a little bit of an adjustment. For the most part, the natural gas has been pretty stable, which is what we've been talking about. The Permian's flat week over week. We lost one in the Williston, which is not too surprising, as we've talked about. So we had a report come out today that looks at China, what's happening with the new trade deal, and then really kind of tying that into what's happening in the U.S. What does that mean for policy? What does that mean for just oil demand in general? And in the very beginning of it, in the first, let's call it 10 pages, we talk about some of these different impacts. And so from that, we're just going to talk and give some high-level points with the other in-depth commentary in the report itself. So when we look at what's happening and we look at the line chart, you can see that obviously we had the 115 up to 130, and now we're at 127. It's just this is going to be where we're going to sit, where we're going to hang between this, call it 127 and 135, and just kind of bounce back and forth, just because on a seasonal level, we normally start to see a drop off starting next week. We're just saying that we're not going to see the same type of seasonal drop off. And if we do, it would just be a one-off and they would come right back the next week, just to kind of give that and bridge that 4-week rolling average. So as things roll off, as we talked about in areas like Arcoma and in Cherokee, it's really just there. It'll get picked up in Texas, which is mostly the Permian, obviously, and then the Eagle Ford. Even though the rig count dropped this week, we did pick up another 2 rigs in the Permian. So there is some activity. There are things that are happening. So just to give some kind of context. So, we expect the Permian and Eagle Ford to remain here, but the Williston or the Bakken in general, we're assuming 8 to 10. There's not going to be too much up or down. We're right within this comfort zone. And typically, the warmer weather shifts obviously go to the south. We saw that there was a 5 spread drop off when it got colder. So obviously there could be freeze offs. Just based on what we know with the weather currently and what's expected into Thanksgiving. Shouldn't be much of an issue. And realistically, so, again, we're saying 127, 135 with adjustments coming in those fringes. And just when we look at it, when we talk about some of these drop-offs, you can see that sometimes we see this little drop in November, and then obviously things cool off going into December. It's just things are adjusting a little bit, because we're in a very unique situation. So even though rig counts are fairly flat, when we look at some of the pieces that we use to kind of indicate where things are going, obviously at this point we have COVID, which is continuing to accelerate. We have crude builds continue to come in. Obviously crude pricing remains fairly flat to stable. And that's why we think that we're just going to really sit in these levels. Not much to say one way or the other in terms of this real drive, but except when we're looking at the Permian overall. So again, Ardmore, Arcoma, Cherokee, Fort Worth, Green River, those are things that we think will start to roll off, especially as we go into December, because the goal is not so much crude price, because obviously it matters, not saying it doesn't, but it's really how do we manage the decline curves going into year end, going into Q1, which we know is going to be fairly tough. So the Denver, we don't talk about it a lot. Denver had a little bit of love over the last couple of weeks, and there's not much to say one way or the other that it's going to go up or down. We think it's just going to stay within these levels that we're seeing here. And again, it's just because managing those decline curves. Anadarko, Uinta, we've seen the very similar in terms of very consistent. And it's just when we start to project out, again, that's why we think on a rolling average, we're just going to see that 127 to 135 hold fairly firm. When we're looking at exports and we're looking out into the future, exports, some sales picked up. So the reason why they picked up is we did get some clearing into Asia. 15 million barrels or so were bought from Nigeria and from West Africa in general. That's going into China. But even with the surge, there was only a 50 cents tightening. Again, like this is always coming back to the problems we continue to see in the global market, which we go down in depth in the report, and we covered in the EIA show, specifically in the third segment. Europe is starting to level off a little bit. We saw, obviously the big drop, and now with the lockdowns, we're seeing cases cool off. We're still seeing some increases in hospitalizations, depending on where we are. But again, things are starting to level off, and we're seeing that in activity. Now, it doesn't mean that we're going to get this big pop into the end of the year. It's just we think, and as we go forward, things are going to stabilize a bit and remain fairly, conservative. But when we say conservative, we have to look at oil demand and oil and refined product demand. And we think that, just based on the data coming out, we saw a huge spike in sales coming from gasoline from Europe into the U.S. Clearly, that was, there was a big increase in storage, which helped open up that arbitrage, which will start coming into the U.S. by about the end of December. But when we look at North Sea, Europe, crude storage remains elevated, which is gonna prohibit U.S. crude really entering into that market, especially as Libya comes back. And they've now stabilized at about 1.2 million barrels a day in production, about 1 million barrels in exports, and that's just gonna again keep U.S. crude from really penetrating into that European market. But we have seen some go to Taiwan, into South Korea and China. But again, it's all about delivery. So everyone's looking at China and what they've been doing, but understand that they're now buying for next year. So when we look at what they've been purchasing, they also normally sweep the market at this time every year ahead of Lunar New Year, because it'll normally get delivered either just before or right after, depending on where they're really trying to plan things. And then some of these might even sit on the water until April, depending on how things continue to progress, because refinery run rates have gotten to about 77, 78%, which is down from that 83%. There are things that we continue to see that give us pause. And then obviously we have the OPEC meeting coming up. And what we're assuming as base case is they don't increase for 3 to 6 months, where there's going to be no increase of 2 million, which is technically an increase of 1 million, because they obviously Libya is coming back. But what we're expecting is just the base case is a delay of increases in the production, because on January 1st, they were supposed to increase by 2 million. A bull case would be that they actually cut about 500,000 to 1 million barrels. But really any kind of cut would be, I think, viewed positively by the market. And then on the bear cases, they instead of increasing by 2 million, they increase by 1 million and allow Libya to come in, and that would be the offset. I think that would be viewed as a bearish sentiment coming into kind of this unknown as we look at activity and where activity looks to sit. So that's all we have for you. The EIA show was a good one. Please check that out. Then we obviously had our econ show. We keep following up on China. We went through the new trade deal. We tried to roll in from last week with what is happening with what could happen with the Biden presidency. What does that look like? And then we're starting to put together why we think fracking is a good mix to the future energy solutions as we go forward, because I think these are things where we want to dispel some misnomers and show why it's safe, why some of the comments that we see about water tables is really inaccurate, and the ways that we can do things and really work together. Because we're not saying that you have no oversight. That's ridiculous. We need oversight. We need people to be held accountable when there's errors. But if it's done appropriately, it's safe, it's effective, it's cost effective for the people that consume the products. And there are things where it's all a matter of finding the right balance. And that's what we're all about, is finding that balance. That's what the private equity fund is talking about and investing in, finding that balance. Energy infrastructure that's sustainable. So that's investing in hydro, that's investing in solar, but it's also taking advantage of green technology and other forms of technology to make what we do safer, better, more effective, and cost efficient. So thanks again for watching. Have a great weekend. Next week, we'll have our normal setup of EIA, Econ, and the Frac Spread Count. It'll be a little bit shorter, obviously, with Thanksgiving thrown in the middle. So have a great weekend. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.